Everyone knows that you're supposed to keep your credit score high, and that it will help you financially if you do so. Most people, however, are vague on what makes a good credit score, and even less sure of how that credit score affects their financial situation. This is a bit of a complicated topic, so we're going to take the time to go over this in depth. Okay, first of all, what does your credit score affect? A lot. Your credit score is a reminder that sort of hangs over your head with almost any major financial institution, and it's supposed to tell them how much of a risk to take on you. The riskier you are, the more they will charge to lend you money. This is true on credit cards, car loans, and mortgages. But it could come up more often than just with loans. Even if you're not getting a mortgage and you want to rent a home, it may come up. Landlords almost always pull credit to get an idea of how reliable a potential tenant would be, and a low score could get you turned down. It could even affect your chances of getting a job. Most employers also pull credit when they're considering who to hire, because a high credit score can be a sign that someone is responsible with their time and action. Your credit score will come up a lot in your life. When you're applying for a mortgage, your credit score affects prices all along the process. First, if your score is low enough, you may not be able to get a mortgage at all. The scores can go pretty low. FHA loans can go down to a 580 at the minimum, so you should still talk to your mortgage professional. But if your score is low enough, the risk is just considered too high. But even if you are approved, a lower credit score also means you get a higher rate and that you pay more for mortgage insurance in most cases. These are often based off of specific credit ranges though, so if you're thinking about getting a home loan, you should talk to a mortgage professional about a reachable, ideal credit score. For example, if you're applying for a loan and you have, let's say, a 615 credit score, it may work out better for your long-term future to pay off a little on some of your accounts to bring that score up to a 620. A lower score means higher rates, worse bargaining power, and sometimes it will even mean you're not able to attain financing at all. In the modern world, a lot of things are decided by the numbers, and when it comes to lending, your credit score is that number. So with all of that in mind, I'm going to go over what you need to do to get a higher credit score. Before I do though, let me be clear about what a higher score is. A 700 plus score is pretty much as good as it needs to be for most credit situations, and at least 50% of the US population is already there. If you have a 700 or greater score, you can still learn from some of the things I'll discuss in a moment, but I wouldn't change your habits too much. If you're below 700 though, these tips could really help to bring your score into that most common range. Conventional wisdom is that all you have to do is pay your bills on time and not miss any payments. But does paying your utility bills, your rent, and your cell phone bill on time lead to a great credit score? Your rent payment, your utilities, your cell phone, even your kid's daycare, none of these things are likely to show up on a credit report at all, unless you get them wrong. So paying them on time won't show up. But if any of those companies don't receive payment, they may report you to credit agencies, which will make them come up as derogatory credit and will bring down your score. On the other hand, there are a few kinds of payments that do work to your favor. Paying your mortgage, student loans, car loans, and credit card payments on time do show up on your credit report. So if you aren't sitting on any loans, it is actually good for your credit to have a credit card with a low balance that you pay on each month. The reason for this is that if you've never been extended credit, you haven't proven that you will repay it. If you don't pay your water bill, you don't have water. But if you don't pay your credit card bill, all that happens is that your credit score is lower. So banks that extend credit want to make sure that kind of thing matters to you before taking a risk. On that note, you don't want to have too much on credit either. The best scenario, if you want a high credit score, is to have a high amount of available credit, a high limit, and a low amount owed. So it looks great if you have a credit card that has a high limit and you only have a small amount owed on the card, because it shows you can handle that responsibility. It's important to note that this will only help if you use the credit card, so make sure you're at least using it once in a while. This chart actually displays all of that very well. The payment history section is what we talked about first, and as you can see, it's a little more than a third of your score. But another third of your score is determined by amount owed. This one takes into account that high limit, low balance situation we just talked about. Just just owing nothing on credit, but also not having much available credit is very bad for this section. With a third of your score being determined right there, you can see why having some available credit is a big deal. The other sections are a little easier to do right, but a lot of people don't know anything about them. Length of credit history is a big one people get wrong. Many pay off their cards and then close the account to keep that off their credit. But they're actually hurting their score in two ways when they do this. One we've already talked about. It looks good to have unused and available credit. The other is that organizations want to see a long history of using credit, so leaving those old accounts open is actually a lot better for your score than closing them out. One note on this. If you're older and you have a great history of credit, you probably have plenty of age on most of your accounts. So don't worry much about this if you have some older accounts that you are already leaving open. Types of credit in use, while a minor factor, does push your score up a little. Basically, this just means that they want to see a variety of credit types. So if you've been paying on a car loan and you've had credit cards, this will look good. But if you've only ever had credit cards, this part will be a little lower. Finally, they look at new credit. This section looks out for a lot of recently opened accounts, and it looks for a lot of recent credit inquiries. This is not to say that you should ever hesitate to check or know your score, but if you're applying for credit from a number of entities in a short stretch, it could be a sign of potential financial issues, so it's reflected on your score. Okay, all of that aside, I want to make something clear. The best decisions for your credit score are not always the best financial choices. We talked about closing out cards being a mistake, which is true for a credit report. But while just having a card sitting around in a drawer will positively affect your credit, it's also riskier. It opens you up to having potential identity theft issues, and just generally makes it easier for you to put yourself into debt without available credit. Paying cash or debit for goods and services is a better financial decision because it means you can't buy more than you can pay for, but not using credit cards hurts your score. Make sure you're not trying to bring up your score at the cost of your financial stability or safety. Okay, that's a lot of information, so here's a quick rundown, just as a reminder. Of course, pay your bills on time. This is the largest factor. Have and use credit, and maintain a low balance on that credit. You want a low balance and a high limit. Don't close old accounts because length of credit history is important. It helps to have a variety of credit types, but it isn't going to hurt your score that much if you just have credit cards and no installment loans like car loans. Finally, don't go credit crazy. Don't open a bunch of unneeded credit cards or have organizations pull your credit dozens of times a month. This one is pretty easy to keep to. Thanks for watching this in-depth video in our lecture series. Keep coming back for our quick weekly informational videos, and also keep an eye out for future lecture series videos to empower you in the mortgage process, even when it comes to the complicated parts. Thanks for watching.